Hello everyone. Welcome back to One-to-One Macroeconomics. In this episode, we are going to be covering aggregate demand. In economics, demand refers to the total amount of goods and services that people or organizations want to purchase from firms. And therefore, in an economy, aggregate demand is the total demand or total spending for goods and services produced in an economy in a given time period. This is typically a year. Now shown on screen is the formula for aggregate demand. This may seem confusing now, but by the end of this video, you'll understand this important formula. You may want to make a note of the definitions and formula on screen now. Now let's get on to what each of these letters represent. The formula will stay on screen so you can refer back to it. Each of these letters represent a component of aggregate demand, meaning they contribute to the total spending or total demand in an economy. C represents consumer expenditure. We covered this in our last episode, and this is the household spending on consumer goods and services. It is possibly the largest component since it has the largest impact on aggregate demand, and it is also sometimes referred to as consumption or consumer spending. I represents investments. We also covered this last episode. It is when firms spend money on capital goods. Capital goods are assets that firms use to produce goods and services, such as equipment for building or offices. G. This represents government spending. We looked at this briefly last episode as a way that money can enter the circular flow of income. But government spending is the money spent by the government on public goods and services. This is another large influence of aggregate demand. X represents exports. This is when products are produced domestically, then sold abroad. This means that it is an example of an injection because it is a way that money enters the economy. M also represents imports. These are products being produced abroad and being brought by domestic consumers. This means that money is spent in a foreign economy, so it's an example of a leakage. X minus M. This is net exports. This is simply the value of exports in an economy minus the value of imports in an economy. Now we have looked at what each of these letters represent, you should understand what the formula means. It means that we know aggregate demand of an economy is determined by all of these components put together. However, to understand the components, we will now look at them individually. Consumer expenditure. This is spending by households on consumer goods and services. It is determined by multiple different factors. The first is consumer confidence. When households are more confident about their economy and their financial situation, they tend to spend more money and save less. This also works the opposite way. For example, in a recession, consumer confidence may be low, so they are reluctant to spend money as they may be fearful of losing their job. High consumer confidence causes increases in consumer expenditure, and low confidence decreases expenditure. The next factor affecting consumer expenditure is wealth. A rise in households' wealth may occur due to increasing share or house prices. This links to consumer confidence because a household's wealth will affect a household's financial situation. The next factor is real disposable income. This is the income of households when income tax is taken and benefits are added. When income of a household rises, this causes expenditure to increase. This is because they can afford more consumer goods and services. However, the more that income rises, the less expenditure rises. This is because households also typically save their money. The last factor that influences consumer expenditure are interest rates. High interest rates make people less likely to borrow money because they have to pay back more. They are more likely to save as they get better returns on their saving accounts. Also, people who have existing loans and mortgages will have to pay back more, so have less money to spend on consumer goods and services. When interest rates are low, people become more likely to borrow money from banks and less likely to save. This means high interest rates usually decrease consumer expenditure, and low interest rates usually increase consumption. Now we have seen all the factors that can influence consumer expenditure. You may want to make a note of these. When consumer expenditure in an economy rises, this causes an increase in aggregate demand because it's a component of it. Now we're going to look at the next component of aggregate demand, investments. This is when firms spend money on capital goods, which are assets used in the production of goods and services. The first factor that influences investments is real disposable income. This works in the same way as with consumer expenditure. Higher income is likely to cause more investments. The next cause of changes in investments is retained profit. This is profit that is kept by firms to finance investments. The more retained profit a firm has, the more likely they are to make investments. The next influence is interest rates. This also affects investments the same way it affects expenditure. Firms often borrow money when they want to make investments. This means higher interest rates makes them less likely to borrow and invest, whereas low interest rates means they have to pay back less on loans, so are more likely to borrow and then invest. Corporation tax also affects a firm's likelihood to invest. This is a tax on firms' profits. So if the government decided to decrease corporation tax, this may mean firms have more real disposable income and are more likely to invest. The extent to which a firm is using its capital goods affects their likelihood to invest. This is called capacity utilization. If a firm has a lot of spare capacity, then they are unlikely to invest in capital goods because they already have some that they are not using. When they are using all capital goods at full capacity utilization, they are more likely to invest so that they can expand. Current advances in technology will also influence investments. This is because firms want to remain competitive with latest technology. This means that when new technology is released, firms are more likely to make investments. The last factor is business confidence. This works in the same manner as consumer confidence. When firms are more confident in their ability to make profit, then they are more likely to invest. Whereas if the economy is in recession and sales are low, then they are unlikely to invest. Now we're going to test your knowledge. You may want to make note of the answers and resume when you're ready to see them. What is a definition of consumer expenditure? This is household spending on consumer goods and services. How will higher interest rates affect consumer expenditure? They will make consumers less likely to borrow money and more likely to save, so it will decrease expenditure. What is a tax on firms' profit called? Corporation tax. How does having spare capacity affect investments? The firm has capital goods not being used, so investments are unlikely. What does X minus M stand for? Net exports. This is also exports minus imports. What factors influence both consumer expenditure and investments? Interest rates and real disposable income. If you got less than 4 out of 6, please return to the slide where the information is located. Thank you for watching. We will cover the rest of the components of aggregate demand in the next episode. Please like, subscribe, and share. Also follow our Twitter for more updates on our channel.